Good afternoon, everyone. Welcome to the Bank's Inflation Report press conference.
Good afternoon, everyone. Since May, global trade tensions have intensified, global activity has remained soft, and the perceived likelihood of a no-deal Brexit has increased significantly. These developments have led to a substantial declines in market interest rates and a marked depreciation of sterling. UK financial conditions have loosened materially as a result, and they can be expected to remain volatile as the prospects for Brexit and therefore the UK economy develop.
PC says that the interest rates in the event of a no-deal Brexit would not be automatic.
The UK economic outlook will continue to hinge on the nature of EU withdrawal, and the appropriate path for monetary policy will depend on the balance of its effects on demand, supply, and the exchange rate. As a consequence, the monetary policy response to Brexit will not be automatic, and it could be in either direction. The committee will always act to achieve the 2% inflation target in a sustainable manner.
Jason, above him, please.
As well as their impact on financial markets, Brexit developments are making UK GDP growth more volatile than usual owing to stock building and auto plant shutdowns. Looking through these temporary factors, the underlying pace of growth has slowed to below potential rates as a result of weaker global demand and more entrenched uncertainty about Brexit amongst UK companies.
You think no-deal Brexit would mean for the global economy? Is it likely to be,
These developments have already led to marked weakness in UK business investment since the referendum. Investment intentions point to further contractions in the second quarter and third quarter of this year, and the MPC now expects business investment to pick up more slowly over the course of the next year.
It says that the policies it's planning to set out are aimed at putting rocket boosters under the economy.
Supported by the resilient labour market, households' confidence in their personal financial conditions is holding up, with spending rising broadly in line with real incomes. To be clear, UK households are acting prudently. This is no debt-fueled consumption boom, and households' concern about the general economic situation continue to restrain housing market activity. Overall, the MPC expects underlying GDP growth to remain subdued over the course of the coming year, with Brexit-related uncertainties and softer external environment both weighing on spending.
In UK growth can actually be reversed by a smooth Brexit and by a resolution in the US.
Headline inflation will probably dip around 0.5 percentage point below target in coming months owing to cuts into energy bills, but core inflation should remain relatively stable at rates only a little below 2%. Looking forward, increased uncertainty about the outlook suggests that the UK economy could follow a wide range of paths over coming years, depending, most importantly, of course, on the nature of EU withdrawal.
Pound falling, inflation rising, growth slowing. Will the measures outlined by the new
Profound uncertainties over the future of the global trading system and the form that Brexit will take are weighing on UK economic performance. Until those uncertainties are resolved, shifting perceptions of them will drive volatility in market interest rates, in equity prices, and in currency values. Monetary policy cannot offset the real effects of these fundamental drivers of jobs, growth, and prosperity. But monetary policy can help smooth the adjustment of the economy to these shocks. And to that end, the people of the United Kingdom can be confident that the MPC will take all appropriate measures to support jobs and activity consistent with achieving the 2% inflation target during these exceptional times.